If you watched episode 16, you know why trade credit insurance works as a portfolio management tool, how it gives exporters real protection on their receivables and lets them grow without taking on unlimited buyer risk. But here's the question I get after that conversation. Okay, I get the concept. Now what? How does this actually work in practice? What am I actually committing to if I want to explore this? Most people don't know what asking for a quote involves. They imagine it's complicated or time-consuming, or that they'll find out partway through that they don't qualify. That uncertainty stops a lot of qualified buyers from even starting. This episode is designed to remove that uncertainty. We're walking through the entire placement process, and from the first conversation with a broker to the moment your policy is live, so there are no surprises. Episode 16 made the case for trade credit insurance as a strategic tool. It established how TCI functions as part of a broader receivables and credit management strategy, not just as a safety net, but as an instrument that gives you clarity on buyer risk and the confidence to extend credit on terms that work for your business. This episode is the follow-through. If episode 16 answered why, this one answers how. What does it actually look like to get coverage in place? Let's get into it. The placement process runs in 5 stages. They're sequential, they're predictable, and they each have a clear purpose. Stage 1. Scoping. The broker gets to understand your business. Stage 2, preparing the submission. You assemble the information carriers need to underwrite the risk. Stage 3, carrier marketing. The broker takes your submission to the market. Stage 4, quote, evaluation and negotiation. You review what comes back and get the terms to where they need to be. Stage 5, binding and policy inception. Coverage goes live. On timeline, a straightforward placement for a clean book of business can move in 3 to 4 weeks. A more complex submission, larger AR, more jurisdictions, some credit history to explain, can take longer. Complexity varies. What shortens it is having a prepared submission and a broker who knows the market. The first conversation with a broker is a scoping conversation. Its purpose is to understand your business well enough to determine whether TCI is the right fit, and if so, which part of the market to approach. Here's what gets covered. AR book size and buyer mix. How large is your receivables portfolio, and who are your buyers? Are they concentrated in a handful of accounts or spread across many? Countries and geographies. Where are your buyers located? Historical loss experience. Have you had buyer defaults or slow payments? And what you're trying to solve? Are you protecting against a specific concentration risk, supporting a bank facility, or trying to extend credit to new buyers you'd otherwise avoid? Once scoping confirms you're a candidate, the next step is building the submission package. This is the document set the broker uses to present your risk to carriers. A standard submission includes an AR aging schedule, a current aging report showing outstanding receivables by buyer and by age bracket, your buyer list with exposures, named buyers, their countries, and the credit limits you currently extend. A company overview, historical DSO and bad debt data from the past few years, and your credit policy, if you have one documented, how you make credit decisions, and what your escalation path looks like. Here's why this matters beyond just checking boxes. Underwriters reward evidence of discipline. A clean, well-organized submission tells a carrier that you run a tight credit operation. That's not a soft point. It affects the speed of the response, the initial limits offered, and sometimes the premium rate. A messy or incomplete submission creates friction. Underwriters have to come back with questions. The timeline stretches, and you can end up with conservative initial limits that reflect the underwriter's uncertainty more than the actual quality of your book. Preparation quality is one of the highest leverage things you control in this process. With the submission ready, the broker takes it to market. This means presenting your risk to a selected set of carriers, the insurers who actually underwrite TCI policies. Not all carriers are equally competitive for all risk profiles. Some specialize in smaller mid-market companies, some are stronger on certain geographies, some have appetite for specific industry sectors that others don't. The broker's job here is to know where your submission fits and who to approach. This is where broker relationships and market knowledge add real value. When quotes come back, you're not just looking at a single number. A TCI quote is a term sheet with several moving parts, and understanding what each one means is essential before you decide whether to accept, negotiate, or walk. The main elements: premium rate, usually expressed as a percentage of insured turnover; aggregate limit, the maximum the insurer will pay out over the policy period; name buyer limits, per buyer coverage caps for your key accounts; discretionary credit limit, the threshold below which you can set your own buyer limits without individual carrier approval; deductible, what you absorb before the policy pays; and country exclusions, any markets the carrier is declining to cover. Not everything in a quote is fixed. The areas where negotiation typically yields results Limit depth on top buyers. If your 5 largest accounts represent a significant concentration and the initial limits don't fully cover them, that's the first thing to push on. Deductible structure. Specific buyer terms, where there's sometimes room to get a conditional approval rather than a flat decline. What to accept. Some buyers may be excluded because the carrier's data on them is genuinely thin. Country exclusions on genuinely high-risk markets are usually firm. The goal is a policy that covers your real exposures at terms that make commercial sense, not a perfect policy that doesn't exist. When you've agreed on terms, binding is straightforward. You confirm acceptance, the premium deposit is due, and the carrier issues the policy documents. Review them carefully. The policy wording governs how claims are handled, what notifications are required, and what the exclusions are. Your broker should walk you through the key clauses, particularly the buyer notification requirements and the waiting periods before a claim can be filed. Once the policy is live, the approved limits for your named buyers are set. Training your internal team is often underestimated. The people managing your AR day-to-day need to understand what the policy requires of them. Binding is not the finish line. It's the starting point of a managed relationship. Most exporters who place TCI for the first time treat year 1 as the test. By the renewal conversation, they have 12 months of data, claims or no claims, buyer limit utilization, DSO trends, market changes on the buyer side. That data is leverage. A good broker uses the renewal to do 2 things. Demonstrate your performance to the carrier. A clean year with no claims and disciplined credit management is a strong argument for better terms. And reassess whether the current carrier is still the right fit. Year 1 limits are often conservative because the carrier has no track record with you. Year 2, you have 1. Year 3, you have 2. The renewal is where the real optimization happens. Let me reframe where we've been. There's nothing mysterious about the TCI placement process. It has 5 stages. Each stage has a clear purpose. The timeline is measurable. What you need to bring is an organized AR book, honest historical data, and a clear sense of what you're trying to accomplish. The broker's job is to do the rest. Position your risk in the right part of the market, run the negotiation, get the policy structured correctly, and manage the relationship going forward. If you're a CFO, treasurer, or credit manager at an exporting company and you've been thinking about whether TCI makes sense for your business, the first step is a scoping conversation. It doesn't commit you to anything. It tells you whether you're a candidate and what the likely parameters would be. That's what Impello does. We work with exporters on exactly this: understanding the risk, preparing the submission, running the market, and managing the policy. If you want to start that conversation, reach out through the link in the description. If this series has been useful, subscribe. Thanks for watching.